Hi, folks, and welcome to the Genis Friday Market Insights. Today's June 4th, and my name is Thomas Holloway. I'm a portfolio manager, and I'm joined by Justin Hahn, the Genis macro portfolio strategist. Can you kick us off with what happened this week in markets that was interesting to you?
Yeah, so the markets this week were relatively flat and quiet as we hover around the all-time high levels for a lot of the indexes. In quarter one, we saw Canadian GDPs expand by about 5.6%, led by the residential investments as the housing market still remains strong there. We also saw continued strength in the US economic numbers with services PMIs there coming in at record highs, which is very positive for the markets. And we also saw manufacturing PMIs bounce up as well above the 50 expansionary mark. This would mark the 12th straight month of expansionary territory for the PMI numbers. We also saw the job numbers released today be a bit stronger than, a bit weaker, sorry, than expectations, but the markets actually took that positively, which we'll cover a bit later. In addition, we also saw the OECD increase global growth estimates for 2022 up to about 4.4% from 4.0%, and also increasing Canada's GDP estimate to about 6.1% and 3.8% for this year and next year.
Great, good summary, thank you. So kind of quiet in the market prices, but information continuing to come in around the reopening and such. So Justin, you mentioned the services and the manufacturing versions of the PMI?
Yeah, so the recent services PMIs this week were actually the strongest on record and kind of illustrates the pent-up demand that's been going on due to all the COVID lockdowns last year. We also still believe there is more upside on the service side, at least as we head into the summer months and travel and leisure pick up, as well as vaccination efforts continue in the US. Manufacturing's also rebounded, still not as high it was a couple months ago, but it is, like I mentioned before, the 12th straight time that the reading has been above 50 since April of last year.
Great. But let's start off maybe with a topic that's still super interesting for us to watch, but I guess away from exactly what Genis invests in, and that's on both crypto markets and the continuing kind of saga of the meme stocks such as AMC and GameStop. What's the latest there, Justin?
Yeah, we're seeing a similar situation as we saw in January and February during those two peaks, where we're seeing a lot of these heavily shorted companies like AMC and GameStop soar up with retail investors coming in. Actually, I think I saw today's report showing that AMC actually owned by about 80% retail investors, which is quite a large portion. Part of this cause could be due to the lackluster performance we've seen in the cryptocurrencies, where cryptocurrencies have crashed quite a bit after Chinese and US regulators began to step in, and also with Tesla pausing its Bitcoin purchasing due to the environmental impact. This also points out the amount of excess liquidity we have in the markets with all the pent up demand from last year and all of the extra stimulus given through stimulus checks and other methods floating around the markets. These stocks are more treated as trading vehicles, more of day trading vehicles than actual fundamental investments. So we kind of are straying far from it and not really looking at it too much, but following the news around it. Um, we also saw AMC today come in and say they're giving out free popcorn to all the investors that they have. So, I mean, if you think about it, any company that would give out free popcorn, you would probably expect their stock to go up as well.
Yeah, it's a fascinating idea. It's like you could buy one share for, I think it's around $50 or $60. That's a little bit pricey for a bag of popcorn, but you can almost justify the share purchase just on that one offer. And then, the other thing that came out this morning that Justin mentioned was the monthly non-farm payrolls report. So this is really the biggest monthly series that any macroeconomist looks at to understand the health of the U.S. economy and in turn maybe the global economy. Comes out early in the morning on the first Friday of the month. So today was non-farms day. What did you see there, Justin?
Yeah, so the US job numbers this month came in slightly below expectations actually for the second straight month, but we still saw unemployment rates still move down to about 5.8%. Although employment still remains strong, economist expectations, we believe, have been a little bit too over optimistic about the pace of the job growth. This actually became quite a positive for the markets. The markets actually shot up today, especially in the tech sector after the weaker job numbers. This is mainly due to a lot of the fears on investors' mind currently is the Fed increasing rates a little faster and begin tapering their large balance sheets. But with a little bit of a slowdown in the job data, investors are more optimistic about a longer run there and a more cautious Fed. Despite also the increase in volatility we've seen in the equity markets, the bond markets have actually been trading quite range bound with the US 10-year at about 1.5 to about 1.75%. And it's been like that for the past few months. So we haven't really seen too much new signals from the bond market.
Okay, so we're going to leave it there. Beautiful end to the week here in Calgary. I think it's the same in Vancouver for weather. So I hope clients enjoy the weekend if that's able to hang in there. If you, as always, if you have more questions or things you'd like to hear us chat about, reach out to your portfolio manager or reach out to me if you like, or Justin. And with that, thanks again for your business, and we'll talk to you soon.
Thanks, everyone.